Good afternoon, everybody. Thanks for joining us. Hope lunch was satisfactory to everybody. I want to thank those people who are joining us on the live stream as well. Once again, I'm Ken Fields, part of the communications and engagement team here. And again, welcome to this stage of the Fed Listens event. During this session, Governor Waller and President Musalem are going to hear from a representative of each of the advisory councils who's been working this morning. They're going to advise on labor market conditions, inflation, communications, and the transmission of monetary policy. Our staff will be keeping them informed on kind of the time frame that they have. Each report out is going to be about 10 minutes long, and then any questions that Governor Waller or President Musalem have. We have 6 advisory councils that are going to provide their insights, and they just concluded a working session this morning, and they will summarize it. Each of the councils has chosen a member to do that report out. I'm going to introduce each of them and then invite them to the podium. And if you're reporting out, please expect to get some questions from Governor Waller and from President Musalem. We're going to hear first from the Agribusiness Industry Council, or as Matushka says, the best council. Then we're going to proceed with the Healthcare Industry Council, as Seema says, the best council. The Real Estate Industry Council will come next, and that is obviously the best council. That's the one I was part of. The Transportation Industry Council will come then, and then after that, the Community Depository Institutions Advisory Council, and then we'll close with the Community Development Advisory Council. So with that, let's begin. We're going to first hear from the Agribusiness Industry Council. Bruce Aronson of the University of Arkansas Division of Agriculture in Fayetteville will be reporting. Bruce.
All right, thank you very much, Ken. Thank you, President Musalem, for having us, as well as Governor Waller. Matushka is a great leader for our group here in the Agribusiness Council, and of course, all the support we get from the St. Louis Fed. Thank you for having us. We started off with labor in the Agribusiness Council. There's still challenges in agriculture and rural remain at a high level. That has consistently been an issue, but particularly on the unskilled labor and immigration issues can only compound that, we think. There's been less pressure overall on wages over time than we have in the past. More people are happy with what they have in their jobs, so there's less of that issue of trying to move for the greener pastures somewhere else, so that's a good sign. Some larger ag corporations, though, are cutting back on employees, cutting back on the number of employees up to maybe 20%, we heard, so that's an issue. There's been cutbacks in innovation, R&D, and marketing, some outsourcing of jobs, not overseas necessarily, but more specialized activities such as IT, accounting are being outsourced. But yes, that cutback in investments, which could be ominous for a longer term compatibility or competitiveness as well. AI, a big issue that's still coming into force and actually being adopted a lot and being used in agribusiness and across the sector. It's not necessarily replacing people, but as openings are occurring, maybe there's not getting refilled because of AI. A real positive of AI, though, is that it's making some of those moderately skilled people more productive and making them become skilled, easier address the underlying problems through AI resources. And that AI is really moving faster than maybe what was expected, but there's been that adoption and a sense that needs to continue to be adopted and put into place. On the inflation side, there's been a squeeze for agribusinesses and agriculture and farm businesses in particular, where there's higher input prices, output prices are poor, and the sad thing, it could be even worse potentially given some tariff situation on particular sectors. Not all, it doesn't cut across uniformly all the way across, but that is a particular concern. There's a lot of uncertainty in government funding farm bill, government programs, and then even if there are funds that come available, they're still dealing with high input prices that have been there and then continue to increase. There's pressures on farmers remaining in business. So there are farmers that are leaving. So there's some reduction in that. So again, consolidation could be occurring on that front. Some people are deciding to not maintain their farmland. So there's some adjustments because of cash rents being too high. And so people have walked away from those, and then there's renegotiations occurring, but some of it may end up being fallow from it. The tightening of credit conditions for farm businesses. Some lenders are pulling back from lending to the ag sector. So there's some challenges there. Some farmers are having difficulty getting their lines of credit renewed. And so that puts on that pressure if they can operate in the first place. And we've actually seen some rent defaults, defaulting on their cash rents. That leads to U.S. competitiveness could be at risk with some of this because of the higher costs of production in the United States, tariffs, there's holds on investments taking place that are really incentivizing other countries in the world to pick up that slack that may be created from the U.S. Not again in all industries, all parts of it, but in lots of particularly those global companies and global people that are producing for global markets. On the Fed, communication, transparency is key, consistent messaging that is clear, putting information in layman terms is really to get to the common person, the regular person, messaging in brief, quick, consumable that's what people are looking for, to have that information. A big shout out to Fred here at the St. Louis Fed, yay, about all that information that's there. Maybe a little clunky in some of it, so maybe some revisions could be held there, but it's a great resource to work with and actually get used by a lot of people. But there's also an interest in getting more localized information. Again, even though you're in a district, there's still a lot of, can I use the word diversity? Diversion across different parts of the Fed. So that's a big issue there. Getting it through different social media, LinkedIn, top news services, Wall Street Journal can get in information, so different sources and trusted sources too can be very important. Really doing a great job with the bankers. I think that's a great, providing information to bankers and educators in the district, but can you do more, right? That's the other thing, can get more to other parts of the district would be good. If we're looking at outlook, looking at 30 to 60 days, so we had 10 people, our votes mattering in our group. You had 30 to 60 days was unanimously pessimistic here on the outlook. Looking at 6 months, I didn't know if that's really long-term, but sometimes that can seem like it's long-term, but really in that 6-month period till the next meeting was really a split between optimistics. There were 3 out of 10 that were optimistic, but they're also selling to that domestic market. And so with the tariff environment, that could be very helpful in that area. But there was 2 that were stay the same, although staying the same was not that great because we were all unanimously pessimistic in the short run. And then for those other 5 were pessimistic in that 6 month because they're operating in a global market. And so hopeful that we can get a situation that will resolve in that period. But again, the uncertainty or the unknown, as was talked about, can be a real issue hanging over the sector. That's our report from agribusiness.
Very good.
So Bruce, that sounds like every farm report I've ever gotten. Farmers are they're uniformly, bankers are always optimistic and farmers are always pessimistic. So what do you, trying to think of what I want to see. You know, things like consolidation in farming isn't a big deal. When you say things start going fallow, that's a whole nother, that's taking stuff literally out of production. And have we ever gone through, except, you know, maybe like the Great Depression, have we ever seen cycles where stuff goes into, land is left fallow and not producing and it becomes a persistent problem?
I mean, where it should happen is on that marginal land, right? So it's the least productive should. But you can have disruptions such that you can't get financing and then it gets delayed before planting, and then just biology takes force there where it's too late to get something in. So it may not be for a long run, but for a season, that could be that. And we have had issues where there's some weather disasters, right, or a drought that could take land out because it was just productive conditions.
And so the other thing I had heard on, you mentioned AI, which most people wouldn't think of AI in farming, but a lot of it I've heard is like the self-automated tractors. AI does a lot of the actual work in the tractors, and that's again labor saving, that maybe people don't want to sit in a tractor for hours and hours on end. So other than that kind of thing, where are you seeing it in the, I can get it in if you're in an office. It's the usual standard office stuff, but in the actual business of farming itself.
Well, some of that adoption of technologies, right? So, you know, being able to shut off the planter at the very exact time, or the application of pesticides at the exact right time is going to be cost saving and more efficient. But there's still someone there that's there. It's not like you just let the tractors in. You're not doing joystick driving too much from you know, South Florida or somewhere like that. So there's still that need to have that. And it's not, you don't want just unskilled labor doing that. That's skilled labor. And there's been a lot of reliance, I know, on a couple of people from H-2A visas. And so some of that can be called into question. Will those continue? There's been need for more of that perhaps, because that gives at least that moderately skilled person to operate that highly efficient but expensive machinery and equipment.
Bruce, thank you. So I had a question on Fed policy. So how do the council feel about the dual mandate, you know, employment, maximum employment, stable prices? How is that understood by the farm community when we're talking about monetary policy? How does that weigh into decision making, if at all?
Well, what I was thinking, half jokingly, if you're employed, you're worried about price, part of that mandate. If you're unemployed, you're worried about employment and prices. So I think there is a appreciation. And in fact, among those 10 council members, it was unanimous that that should be maintained. It's very much appreciated. It needs that. The other thing I didn't go over is that you know, remain independent and apolitical for the Fed. I think that's highly valued and appreciated for that. You know, I think for me, looking at a 14-year term for a board of governors puts it in that long run outlook, right? Looking at what's best rather than looking at a short run. So I think that is still very much appreciated, at least the people that are thinking about those issues.
Thank you, Bruce.
Anybody in the Ag Business Council, where did I drop the ball? Multiple times maybe, but hopefully not.
So you did bring up something I'm surprised that I shouldn't be, but you know, you made a big point about Fed communication, and how are we doing?
Like I said, I think it's Fred, great resource. Now the common or regular person may not be accessing that, but I think it could be better, right? To get out to outreach in more targeted ways, perhaps too, getting out in respected news organizations, newsletters, for example. Again, people are looking at quick, to the point information coming out. So I think that's good. I know I value getting the different survey data of what bankers are thinking about. So I think that's appreciative.
No, I meant me and Alberto. How are we doing on communication?
That's way above my pay grade.
Oh,
I think,
okay.
on that things. No, the idea, right? Keep your eyes on the long run, right? Looking at what's best in the long term, looking at clear messaging. So coming out of the FOMC meetings, I think that's really important. It's not looking back in the day where you were wondering what's going to happen. How is Alan Greenspan carrying his suitcase or his briefcase today? Speculation. It's more like, here's what if would happen if this kind of report might come out versus the other. So at least there's some guidelines or at least expectations for that.
This was fantastic. Thank you.
Great. I appreciate it. Thank you.
Bruce, thanks for a great report. Ag is such a big part of the district that we serve, so thank you for doing that. Next, we're going to hear from the Healthcare Industry Council. Rami Alijil of People Processes in Memphis, Tennessee, is going to give the report out. Rami, come on up.
All right, good afternoon. Everybody awake after lunch? Holding together? Okay. Well, as always, healthcare is incredibly positive. We're just full of joy and rainbows. But I'm going to have to go over a couple things. Just as a reminder, for those of you who maybe haven't seen much about healthcare, we're a relatively unusual space. The person who needs our services really needs it, nearly unlimited demand. All of our problems are supply-based and getting paid. It's quite difficult because the person procuring the service normally isn't the one paying. In most cases, we're locked into long 3-5-year contracts. And in the case of, say, 40 to 50% of rural healthcare, our only client is the government. And they're relatively hard negotiators. So we have a couple of issues that make adjusting to market conditions quite difficult. In our labor market conditions, we have a couple of key things that have changed recently. Compared to COVID, at least, we have had an increase in applicants. There seem to be more people looking for jobs, especially in the entry level or new to the career. We also have a permanent issue in that there are more patients, old people, than there are young people to serve them. We are a pyramid scheme, right? We have lots of people who have to provide service, and they're getting younger, and the patients are getting older, and there are fewer providers to patients. With that supply constraint, it's not surprising that we have issues in filling in a lot of roles. The roles are highly competitive, and at the organizational level, because we can't control our pricing, it's somewhat difficult for us to compete for talent, especially here in our district. Lots of our rates are set by negotiation with large insurance companies, with the government, and they go, Tennessee, Kentucky, let's pay you half of LA. Makes sense, except all of our doctors can move to LA. So we run into issues significantly with supply of these. In general, for new stuff, less stress, better supply, we're better able to fill entry-level positions. We have the same issues as always with high-skilled positions, and we're seeing a hollowing out of the middle-tier position, and that's becoming more and more prevalent. Things like laboratory techs, x-ray techs, not necessarily multi-year college degrees, but that middle tier, the blue collar of medicine, is becoming very, very difficult to find. Recent graduates don't want to go to those schools, right? That's not the desired career path. Those schools are not making much money providing it, so they're dropping those programs. And we're seeing a hollowing out of that middle labor market. Quite difficult. That's about it. Long term, we got a problem also because we just don't have enough. We got to figure out how to deliver more care with fewer humans to more people. So there's an issue there, but it's not necessarily something we got to figure out in the next 3 months. On the other side, we have inflation. I'm going to break this into the drivers of your costs and then what that actually has an effect on your pocketbook. On the supplier side, on our side as medical providers, there's just like all of your fields, very wide. There's venture capital funded pharmacy and coming up with new drugs and writing new softwares. And there's also hospitals and specialists and insurance companies and pharmacy benefit managers. There's lots of pieces, and they're affected very differently. But in general, we're seeing a pretty steep increase over the last few years in labor costs. Started with COVID, went through the roof. We've been fighting that. The last 2 years, we've seen 10 to 11% increases in labor costs, significantly ahead of inflation. But they're kind of catch-up years. And we're expecting that to somewhat settle. Hopefully. Could be. But in general, it's not as bad as it was during COVID, which is about all we can, that's always our positive refrain. At least it wasn't that. On our physical goods, that's everything from masks and syringes and to actual pharmacy goods. The budget is something that should be, at inflation, 3%. It's looking more like 7% right now. And there have been many projections that would be as high as 15% under tariff pieces, because a lot of that stuff is produced overseas. That could be a significant increase in medical costs. Around 50% of our costs come from people. Other 50% come from everything else. If those other things go up 15%, that could be a significant increase in your costs. The impacts of tariffs are unsure, and it's the biggest issue that we're looking at in our 6-month projections, outside of changes in government funding we're going to come to in just a second, is we don't know our supply chains. There was a factory in North Carolina about a year ago. They got hit by a hurricane. Turns out that factory produces 80% of IV fluid used in the United States. 250 different brands, bought from different people, but 80% of it was made in that factory. We found that out a week after the factory went down, right? It's like we don't know necessarily where some of this stuff comes from. So the effects of tariffs are highly uncertain on what that's going to look like. And if it does lead to supply shortages in medical, people really don't like not having their supplies, right? It goes through the roof very quickly. So we don't know what that'll look like. On the consumer side, your actual expenses when you go to the doctor, again, these are under long-term 3 to 5 year contracts. There is a ton of pressure to cut medical costs. Medicaid in particular is facing severe federal revision. And it's the first time in a long time that that's really, we've had lots of, the healthcare market is not a laissez-faire free market. It has constant government interference, and that's good or bad. But this particular case is simply to be cutting a lot of it. Medicaid, in particular, is for the poor or needy. And in rural hospitals, that can be a huge portion of the patient load. We expect if we see those sorts of changes, say 6 months or a year out, even marginal changes, cuts of 5, 10% to those sorts of budgets. And they're proposing a lot more than that. We don't know exactly how rural healthcare would continue to function. It's just not clear at all. And that could be a significant change in how those work. Of course, Medicare and Affordable Care Act issues and how your employers provide insurance, those all have effects too. But at the moment, for the first time in a long time, going to our credit ability, many of the credit rating agencies are flashing caution signs over the next 6 months on healthcare for capital expense projects. And that's very unusual. We could normally get our hands on money to build a hospital. Operate it profitably or at all, that's a whole nother problem. But large capital expenses in healthcare can normally be financed or bonded, those sorts of things. But there are proposed changes to things like the tax-exempt status of hospitals or the tax-exempt bond market. And those can have severe impacts on our ability to continue to develop medical care. So that was a big concern across when we're thinking about our costs over the future and whether or not there's available capital. That uncertainty has led to not just 18-month, but even 10-year projects getting paused temporarily because we're not sure about the continual funding, and the cost variations in that can be so huge that they're not even worth. We have to wait to find out what that's like. Finally, on communication, there is a great confidence of the non-political nature of the central bank and an appreciation of it inside the room. In general, though, about 1 in 5 of our well-educated friends know what the heck you do, though. Like, and those are the smart, you know. It's not, what we discussed is that this is to maintain the independence of the Fed is probably not an aggressive fight you're going to want to engage in, but instead approaching it from a position of education, why you want an independent Fed, what happens when you don't, what the mandate is, these sorts of items in micro-learning content on social media, TikTok, throw a cat at them, do something, but cover the very basics of why you do what you do and why the Fed is structured the way it is. And I think you will have much more success. Even among those who are not necessarily, the success of the Fed remaining independent is going to become a public discussion. And that means that you need to have the reasoning for its independence in the broader public. And again, for advice, talk to Seema. She has a hilarious TikTok about it. She can put those around. That's all I have. Okay. Any questions?
So a couple of them, yeah. So one on the fixed pricing, that government administered pricing. That's only one way that you pay a price for stuff. The other is with your time, so ration care, or to the quality of what you get. So just because the price doesn't move doesn't mean what we experience as consumers isn't more expensive.
Absolutely.
So that's always one point to keep in mind. But at the same time, you're kind of middle labor force hollowing out. To me, this is where AI comes in.
Absolutely.
Right?
Our
Everything
ability
I've
to
seen
adapt.
is you can use AI to do amazing amounts of analysis on X-ray techs or any of this and be pretty accurate on this. So this is actually a hope, I think, for...
That's exactly right. And I think that's one reason, because it's almost a supply issue. It's not a demand. We need X-ray techs right now. We need lab techs desperately. But maybe no one wants to become a lab tech because they're pretty sure we won't need them in 10 years. It's entirely possible. In the meantime, we are filling in with lower skilled and trying to utilize technology to push it. And AI is spreading like wildfire here, just like everywhere else. But we're not there yet. And in the meantime, there are real consequences to not having those in terms of people's laboratories. So it's kind of a big deal. But you are right that the hope is that those middle tier positions that are hollowing out at the supply level will find the alternative, and the demand will switch to match it. Just at the moment, we're screaming about it.
Rami, thank you. That was great. You mentioned the capital rationing for projects because of uncertainty about pricing support from different government programs. Is that the case at any interest rate, or are there interest rates or yields at which and I don't mean Fed interest rates, I mean market interest rates, project interest rates at which the projects might go forward, or is there none at all?
So interestingly, our again, and some of you who have more experience in this, feel free to chime in, but our cost of capital has remained relatively low. Our ability to raise funds through local government or just general tax exempt, the bond market has been actually quite good. But for the first time, credit reporting agencies are telling us the forward outlook looks relatively negative. It looks dangerous. And I've been on the council 8 years, and it's kind of wild to me, but you ask around that council, anyone want to build something? Can you get money? And the answer's like, yep, no questions. We just move on. This is the first time that question has come up. There have been concerns about our ability to finance future projects. And I think it has more to do with the tax-exempt status and tax-exempt bonds and the credit ratings on the changes in the fundamentals of government support in these rural projects, which is where a lot of this happens, than it does necessarily on the interest rate. But would anybody care to correct me on that, or does that sound about right? Yeah.
Well, thank you. I had a follow-up, different question. You're a price taker on the services side, although, as Governor Waller said, you can think of pricing in different ways. And you spent, I didn't time it, but I think you spent 2/3 of your time, 3/4 of your time talking about prices. Talk about the labor market, tight in the middle tier. Going back to how we're doing and communicating things.
Yes, sir.
How do the council feel? How do you feel in the industry about when we are communicating monetary policy, the why part, is it well understood by folks in your industry? Are we more focused on inflation? Are we more focused on employment? You didn't mention the word unemployment a single time.
That's right.
So I wondered how you're thinking about it.
That may be my personal bias, Joe. I have an opinion on that. When I asked the council whether in your if you had to pick one, right? Legs or the head? What are we doing? Unemployment or inflation? The feeling I got was they were shocked you couldn't just always do both. So good luck. My opinion is that inflation, if you don't fight the inflation beast first and foremost, whatever you do on unemployment, you will then have to kill to fight the inflation beast again. So I think inflation first and foremost, but that is my layman's opinion. And the answer from unanimously outside of me was do both, so I don't know what you're asking. So, yeah. And then as far as communicating the why, I really think that's the biggest part missing. I think even well-educated consumers I feel like they have a good grasp of what you do. I don't think the grasp of why you're structured the way you are, what happens when you don't have an independent bank, when you allow political control over monetary supply. I don't think that educational knowledge is really widespread, even among some of your most educated consumers.
Let me just follow up. It's one thing for us to always talk about it, but then people say you're just self-serving. It's you all need to go out and talk about it. You need to go out and say, this is why we want to have an independent central bank. Because it comes from you, it's your neighbors, your peers, your business colleagues, and you don't necessarily have a stake in it like we would potentially look like. So one thing I always ask of everybody, if you like working with us, you see the value of us, please go out and communicate that in your daily lives.
My TikTok is coming.
I stay off of social media for lots of reasons.
Yeah.
Are there any other questions?
I did not, Rami. Thank you again for
Thank you.
And the whole council. Thank you.
Rami, that was great. Thank you. Okay, now we're going to hear from the Real Estate Industry Council, and Madison Silver of Brescia University in Owensboro, Kentucky, is going to be presenting that. Madison?
Thank you, Ken. President Musalem and Governor Waller, it's good to be with you both today. I think I probably express it for everybody here. It really is a joy to get to participate in this and an honor to get to participate in this. And I've gotten to do it for the last 6 years. And I'll just say, as the nerdy kid in Western Kentucky who wore a bow tie and loved his economics class, this is like being a baseball fan and getting to go play for the Red Sox. It really is. I know that sounds crazy, but that really is how it's been for me, and I appreciate the opportunity so much. On the real estate side, from labor, we really see that labor has stabilized for hospitality and for management, but some professional services seem to be a bit softer. Sales can be difficult, particularly as people want to continue to work from home. Sales is not an easy thing to do from home for real estate, as you can imagine, yet somehow that's still out there. Skilled labor also still very hard to find, and apprenticeships are hard to access. Too much red tape, too many qualifications to be able to get into an apprenticeship when we know that we need those so much. There are challenges for subcontractors who cannot fully staff, and we understand the duality of saying we need freer money so that we can do developments, but also there's nobody to build them if we had the money. And we recognize that's a challenge. People are trying to figure out still what return to office is going to look like. That is still very much in flux. And that affects not only real estate that's available, but also operations. And also mentorship of younger workers. We're finding that sometimes it's our more mature, more experienced employees who don't want to come back, and then they cannot mentor those younger workers to be better. But speaking of younger workers, on the labor side, we still see a great deal of anxiety. and particularly among younger workers who have been through so much, really. This current crop of younger workers tend to have a lot more anxiety about a number of things, not just the economy. And so the mentorship that they need is a little more needs to be a little more structured than probably what I was given when I was first starting out. There is some anxiety among senior workers, and that's regarding AI. But the point was made in our group that it is our more mature, more experienced workers who are needed to train AI. So they probably should feel more confident in that than anything else. The difference between training AI and using AI, certainly, but their expertise is needed and is vital to make that work. We are seeing some unevenness in the labor market, particularly in urban centers with higher crime rates. But other issues are causing this, such as the uncertainty from tariffs, which has already been mentioned today. We're starting to see the impacts of increased immigration enforcement on the labor market, and certainly as it relates to our subcontractors, we are starting to see a challenge of having skilled work and that middle skill work being fulfilled, projects coming to completion timely and at a decent cost. People are not moving now, because this relates to the residential sector of real estate. People are not moving because they want to, but because they have to. We heard about the 5 Ds in our real estate council today: death, divorce, diamonds, diapers, and deployment. The reasons that people are really selling their homes, not because they want to. And this is impacting the housing market. We're seeing the impacts of uncertainty and anxiety through increasing requests for help with residential rents. And these are unpleasant echoes of the COVID pandemic. For those of us who were in real estate through the COVID pandemic and dealing with residential rents at the time, it took up a lot of our time. And when you start to see those requests tick up, can you help me this month? I'm going to be a little short. That probably makes all of us in the Real Estate Council a little anxious. Generally, people are also nervous to hire. The uncertainty in the marketplace right now, no one wants to hire someone if they don't think they're going to keep them for a long time. It's not worth the training. It's not worth the effort. It's not worth your time. And so if there is a question about that, then we become nervous and choose not to hire. On the inflation side, insurance and construction costs and labor costs are all up, and they're not expected to stop. And probably the biggest question mark for us is insurance rates, which are increasingly unpredictable, almost impossible to budget, and loom large on our budgets. We heard that inflation from our group was more of an expectation than a mere possibility, as all of these inputs are expected to rise: insurance, construction costs, and labor costs. Overall costs continue to be the biggest driver for both new development decisions as well as price sensitivity for consumers, so it's hitting new projects and hitting the viability of projects that have come out of the ground. Housing inflation is also an issue, as institutional buyers are buying single-family homes, chasing yield, which takes away opportunities from first-time home buyers. On the communication side, to echo what's been said, a more basic understanding of the Fed's role is needed by reaching different people through different mediums, meeting them where they are, particularly more education to low-income and marginalized people in society, as well as a younger audience. How do you counter-program conspiracy theories? I don't know. If you can figure that out, then we can deal with a lot of problems in society right now. But it is much easier to understand a conspiracy theory than it is to understand the role of a macroeconomy and a large institution within it. The Fed may also have a role in encouraging the fiscal side of the economic policy house to make sure that the inputs of a strong economy, like education for labor, smart public infrastructure for land, are prioritized, that they're important, and that will make the Fed's job easier. My favorite quote. We took some some comments over the internet from some council members who could not participate with us today. And my favorite quote from that was, quote, "For the love of God, keep the Fed independent of the executive branch." And I think we'd all echo that. We unanimously believed, unfortunately, at the end of the day, that the economy would worsen over the next 6 months, with the majority of the group believing it would be much worse over the next 6 months. And that's where we ended, truly giving economics the moniker the dismal science.
So in the real estate, so we often get a lot of, I'll say at the board, we get a lot of housing, real estate presentations. And, you know, commercial real estate has been bad since the pandemic really hit. There was a big concern about refinancing waves and defaults, but that doesn't seem to have created a huge problem so far that I've heard. So what's the outlook from the council in terms of commercial real estate going forward? And then we always hear about a shortage of housing, in particular affordable housing. And so any inputs or thoughts on those two items?
I think on the commercial side, it really depends on the sector of the commercial side. So, you know, if you're talking to our retail folks, they'll say retail's doing well, particularly as it relates to restaurants, for example. If they are chef-led concepts or local concepts, they tend to do well. Grocery is up, and so on the retail side, yes, there is a flight to quality, but that flight comes at a price, as Class A office space is having to attract to fill those spaces with some discount, certainly. And so I don't think you're going to see a lot of new investment in commercial Class A office space. Really, the issue that we're dealing with are abandoned office towers in city centers, and the continued question of how are those redeveloped over time. On the residential side, you have this competing issue of, yes, there is a problem with first-time home buyers and startup housing, but when you have a labor market that's suppressed in the trades, and that hour of that person's time could be spent building a mansion that's going to have a higher margin, or a starter home, the choice is pretty simple as to where that labor is going to spend its time. So that's probably not going to solve itself anytime soon.
If I were to ask you, what is the one impediment to increasing the supply of affordable housing in the U.S., what would you tell me?
I would tell you that if I could answer that question, I'd be sitting where you are.
Well, obviously I don't know. So
I think I think there are a number of factors. To choose the first, I don't know. You know, I'm on the higher ed side now, and it's why I'm leaving the real estate council. And I can say from the higher ed side, we've created unreasonable expectations of what students can expect when they first get out of college, and so that is that's a shame. As we've built dormitories that are so nice that when they get out, they've got to have a $2,500 lease in order to maintain the standard of living that they had in college, and that's just not reasonable. So I think we've got to temper expectations as to what people can expect when they're starting out, and then we've also got to be able to make sure that we have methods of scrutiny available to be able to provide loans and low-cost housing to people as they're starting out, because this generation that's coming out right now, probably more than any other, is starting not on third base but on negative third base. They have had one calamity after another that has made it harder for them to be able to afford housing to start unless they can rely on the wealth of the family that's already there, which creates incredible gaps for minorities in this country, and that's got to change.
I do want to make one comment about something you said, because I think it's important to some of the discussion, which is, it is not our job to tell fiscal authorities what they should be spending money on. This is the guaranteed way you lose your independence. I don't tell the government what to do on fiscal policy, and I ask them to please leave me alone on monetary policy. So we do not want to get in the business as members of the Fed to go out and tell Congress, you need to spend money on X, Y, and Z. We may think that is, but that's not our job. So the minute we start getting involved in advocating for certain fiscal policies, you are opening the door to having the reverse done to us on monetary policy.
Yeah, and do you think that there is a difference between doing that and then saying these are things that are important because these are the basic inputs to a good economy, not getting into specific policy, but saying education is important, transportation is important.
Yeah, I mean, we have in St. Louis, we have a very good economic education group. I don't have any problems with that being in the Fed. It's about providing financial literacy and economic education. That's great. Education is important. And education, not just, as you were pointing out, not just in college. We need people in the trades. That's where the biggest gaps are right now, right? And you don't have to spend $100,000 in student loans to get that education to be a plumber, electrician, things that are very valuable that, by the way, AI is not going to get rid of. So it's not just higher education, it's all forms of education that make us more skilled workers.
Agreed.
Madison, thank you for the Red Sox analogy. It's nothing like that, let me tell you. So I have two or three questions. One is, when we heard from the other councils, I think your council too, the outlook is, it's cloudy, some use the word negative, et cetera. And you also said that companies, at least in your sector, are hesitant to hire people unless they're going to retain them for a long time because of the training costs and other costs. I'd be interesting to hear from you and maybe the other councils. Are you hearing of expected or planned shedding of labor, given the outlook that you all have outlined? So that's kind of the business cycle question. I have another set of questions I'd like to ask.
Yeah, I think there were some comments regarding some shedding of labor that was already happening. In fact, particularly as it relates to residential real estate. So you're seeing a decrease in agents because of the contracted supply. They just don't feel like they can maintain a standard of living that they would have if there was enough supply in the marketplace. And so you're already seeing that from a sales standpoint right now.
Thank you. And here's the non-business cycle question. It's this is on the communications and call it transmission of monetary policy. So last year when we reduced interest rates by 100 basis points, and this is something that the CDAC might want to comment on also, we heard from bankers and folks in your sector that there was confusion. Why were interest rates going down, but why were 10-year rates going up or mortgage rates going up? So it goes to the transmission of policy and our communication around it. What's the recommendation there in terms of what we could do better in terms of communicating our stance of policy and how it transmits through the economy?
Well, I don't think there's anything wrong with saying here's what we expect to happen as a result of the decisions that we're making today. And so I know there's some danger to that, because if it doesn't happen the way you think it's going to happen, then you immediately you erode a little bit of confidence, because then it's a question of does the FOMC know what they're doing, right? But at the same time, I mean, there's probably some basic things that could be communicated along with a rate cut of 100 basis points to say that we don't expect this to immediately affect mortgage rates today, but here's what it does do, and here's why we're doing it. I don't think there's anything wrong with that. I think the public would welcome that.
Thank you.
Thank you, Madison. Madison should be noted that he went from real estate to a nice, soft, simple job working in higher ed right now, which is not to be dismissed. So thanks for doing that. Next, we're going to hear from the Transportation Industry Council. David Parrott from UPS Airlines in Louisville is going to join us.
First of all, I just want to say thanks to everybody else in the Transportation Council. We had a really good, lively discussion on all these different questions that were posed over the 2-hour period. There were some recurring themes within our council that you've already heard from most of the other councils as well. Maybe a few little tweaks here and there. But I'll start with the labor market and what we're seeing from our point of view. And for the most part, we're seeing a much more stable labor environment than perhaps we have since COVID hit, and we all saw the disruptions from that, whether it be lack of employees coming in, as well as all the wage pressure that we saw. There is a little bit of a differentiation between the labor force, and we've already heard it from a couple of the other groups. From a white-collar employment standpoint, much more stable. The employment basis is there and available. When you get into some of the skilled labor market, much tighter, and trying to find the right candidates and maintain the wage at a reasonable level, a little bit more difficult. So seeing the exact same thing that some of the other councils have already pointed out. Wage growth also normalizing versus what we saw 2 or 3 years ago. Kind of polling the group 2 to 3% year over year seemed to be the norm, with some pockets in the 4 to 4.5% range in certain markets. But overall, very stable, which is a great sign. When we start looking at the existing workforce, seeing lower attrition, and a lot of the hiring is tied to attrition and not necessarily growth. So whether it's retirement or the occasional folks that are having other opportunities, but seeing less and less of that, and the existing workforce really more comfortable with their current position than going out and seeking new opportunities. It's the exception, again, really with the skilled labor force, where there's opportunities everywhere, and continuing to see price pressures up as you start to compete with other entities. From a workforce quality, the comment was made about the applicant pools are growing versus not maybe getting for a particular job. Maybe you had 10 or 15 candidates, now you may have 100. But when you start to pare it down to those with the capabilities and the requirements needed for the job, there's a large portion of it that continue to not fit the need the way you need them, whether it's skill sets or other issues, drug testing for certain positions. Just a lot of the employee base there really getting cold out. When we talk about inflation, again, I'll frame it up as the overarching theme was we're getting closer back to the historical norms, which is a pleasant place to be, with the caveat of kind of the unknown of what's the impact longer term on the potential tariff issues. A lot of concerns tying into that, as well as into investment decisions that maybe we really haven't seen a lot of those decisions starting to change yet, but certainly is becoming another point of questioning on how much investment are you doing? Do you take a pause until we get through the next 90 days, 6 months, to figure out what the end state is there? When you talk about the impact of inflation, we talked a lot about who is feeling the most pain. Certainly an outsized impact when it comes to the low and moderate income groups. The perception of the impact is really from a combination of things, whether it's uncertainty that we're seeing now and exactly what the direction of the economy is going to be, as well as the impact on that lower end income group from base goods, whether it's the groceries or the rent that continues to drive up the discretionary income being impacted by all those factors. As far as going back kind of to the investment decisions, Availability of credit really didn't seem to be an issue, at least at this point. It was really what's the interest rate that you're going to be getting on those investments, and that's starting to impact whether how much investment you're doing or reprioritizing what the price points are going to be for your return requirements on them. From a communication and transmission of monetary policy. So monetary policy, from our perspective, was much more prevalent on our decisions on the borrowing side, not necessarily the savings component of that mix. So going back to the investments, where does it make sense given the overall debt costs? Higher mortgage rates continuing to kind of put a damper on the housing inventory as people are hesitant to shift from one house to another, knowing that incremental change from some of those very, very low rates that people have locked in. So very common with what we heard from real estate there. As far as the duality of the monetary policy, I think it's a similar theme to what some of the other groups talked about. The driving factor would be more centered towards the inflationary factor than the unemployment, given other impacts on how you manage the unemployment, whether it's typical supply and demand impact, also influenced by the inflationary pressure. But managing that part of that duality seemed to have a higher priority within the group. And then from a public perception, I won't restate some of the other common themes about the communication and education for the average citizen versus maybe the group that you see here. But one thing that I think came across multiple times about maybe some confusion is when we start talking about impacts of inflation. We typically only hear about that year-over-year impact of inflation, not the compounding effect over, say, the last 2, 3, 4 years. So when people are thinking about whether it was an effective monetary policy in driving down inflation, we're talking about, hey, we're in the 2.5% range now. It's being effective. When your common consumer is looking and saying, no, everything is still so much more expensive than it was, say, 2 or 3 years ago. So that mitigation of future inflation impacts versus what's already there maybe is a little bit of a disconnect in how it's being communicated. From an outlook perspective, we were a little different from some of the other groups. We certainly had our share of pessimism in the short term, but we were almost evenly split between pessimism and optimism. We had 4 pessimistic, 3 optimistic in the group. The common theme between them was the uncertainty of our prediction, knowing what we've got on the political side just with some of the policy. I don't think there was an overwhelming, I guess, perception of whether that policy long-term would be good or bad for the economy, just uncertainty of what that policy actually is. And looking at then back to the Fed's role in that, it was about stability. And knowing what we're seeing as far as the uncertainty that's coming in the short term with some of the policies is being able to rely on the Fed to be more of the steadfast, steady rock, predictable. Here's what we see as the outlook and some of the drivers, and based on that, your decision is staying very consistent and predictable in how you are going to manage the monetary policy based on that predictor. And that's all we've got.
So David, thank you and thank you to the council. I had a couple of questions. First, a comment. I really appreciated the comment on clarity on the inflation performance. Now, what are we talking about? What period are we looking at inflation over, whether it's backward-looking and or forward-looking? I took that comment really seriously. And also the comment you just made, I think the last comment was about the why. Explain the why of the framework. You know, what are the inputs into the framework such that you're reaching this decision? Communicate that very clearly to people. I appreciated that. I've been dying to ask this question of this group. With all that's going on with potential supply chain rethinking, the transportation logistics industry is at the heart of it. How are you all thinking about it? What are you all seeing? Are you seeing supply chains beginning to be restructured, rethought, repurposed? That's the first question. And the second question is, only a couple years ago, we were hearing a lot about technological improvement and innovation in the logistics industry and transportation industry. You know, from driverless trucks to all kinds of other innovation. What are you all seeing there? So two questions.
We didn't really touch on the innovation much in the council, so I'll frame it up from my perspective with my company. And I can say, we certainly continue to invest in technology. The driverless trucks, there's been some test bases for that. I think we're still several years away from something that makes a lot of sense of further, heavy investment as a direction. But at least internally, we're investing the vast majority of our CapEx into technology solutions that take some of the pressure off of the labor pool, which has gotten quite a bit more expensive, to be able to manage through that. So we're investing in automated hubs, and really that's our main focus. The first part of your question was with tariffs or potential tariffs, we're going to have companies rethink, customers, everyone rethinking where they're buying things from, where they're sending things to. So all those relationships may change. And the logistics and transportation industry seems to me is at the heart of that. Are you all seeing the footprint of coming tariffs already in the economy? If you are, where? If you're not, when do you expect to see them? Yeah, I'll open it up to the rest of my group. From their perspective, I'd say short term really has been kind of dependent on where you're looking at. So we've seen some additional business because people are trying to prep to get ahead of potential tariff issues. So when you talk about the international trade lanes, seeing some short-term gains there, but it's really pre-positioning. I wouldn't say it's a trend as much as it is a short-term timing issue. The rest of it's really tied to general economy. What's the impact of it over the general economy? Because the short-term blips will manage themselves out. It's really about, are we in an overall trending, softening economy, or are some of these impacts going to be beneficial? I don't know if anybody else, from the ground transport side may have a different perspective on that.
Just can confirm anecdotally a reduction in cross-border shipments between U.S. and Canada, particularly like mid-March to present. So that would be very recent data that will probably take a little bit to show up in any sort of real reports. There's some nuances to that just pre the most recent issuance. Canada was not having to fill out the paperwork in order to not have any tariffs under the USMCA agreement. And so they had not gone through the necessary process to do that. Now, under this scenario, they could still qualify for the tariff, elimination of the tariffs, but they have to go through the process. So there's been a lag in that and just some reduction in cross-border shipments. And then I'll just echo what you said. The supply chain cannot change any faster than we can accommodate it for it to change. So if there are no U.S. options, then there is no manufacturing or products within the U.S. additional to move. And so while that is a long-term aspiration, I think, to have more opportunities to move domestic freight, it's going to take time for that to happen.
I think the quote I wrote down here from someone in the group, and I can't remember who had said it, but uncertainty is stifling. And until we really understand what the rules of the game are, we really can't predict what we need to do to change, whether it's the hard assets that are required for the transportation, or in our case, where we're deploying our assets to make sure that we're hitting the transportation lanes that are needed, that may look a little different depending on what the final resolutions are.
I'm just going to touch on, I haven't said anything yet about framework in any of my questions, but one of the comments you made struck me that in the last framework review, we had gone through a decade where we couldn't get inflation up to the 2% target. And so a lot of what we talked about in the last framework review is, well, we need to run inflation hotter so that on average inflation expectations come up. And it's a very geeky economic explanation. And people would say, but why do you want my cost of living to go up more? And this was a very basic question. Then we get, well, because of the natural policy rate, we want to be able to cut when the recessions are lower, we have more room. Why do you want my cost of living to go up? So it was a very straightforward question that people said, and we kind of ignored it, I would say, because we were so focused on the zero lower bound on policy and how do we get inflation expectations back up to 2. And what we've seen is that, yeah, people don't like inflation. They really don't like inflation. And even if you get, you get these price level jumps, they still remember the jump. Even if it goes back, the growth rate goes back to 0 later. The level is still higher. And I would say one of the things I learned in this experience was, as an economist, you'd say, prices went up 10%, but your wages went up 10%. You're no worse off. So, quit complaining about the price increase. But then there's this natural reaction. There's a lot of academic research that's actually pointing this out, that when I say you got 10% increase in wage, I deserved it. The 10% price increase was unjustified. So even though in real terms you're no worse off, there's a psychological scarring of that, and I think that's what you were alluding to, that people just really dislike the fact that prices are much higher than they were, forget about what's happened to my wages to compensate for it. And so, again, this is something we have to be very conscious of. People hate inflation. So it's something we have to really focus on and not just say, things will adjust and it won't be a problem.
Yeah. And to that point, I think everybody understands 5-7% is something that there's a large distaste for.
Yeah.
But why 2.3 or 2.4? It seems arbitrary, and why isn't 0 really what
Exactly.
the end target is? Same with unemployment. Why is this the sweet spot and not something lower? Because you want everyone employed, right? So. All right. That's it.
Thank you.
All right, thanks.
Thanks, David. Lou Ann Cundiff, from the President and CEO of the First State Bank of St. Charles, is going to join us for the Community Depository Institutions Advisory Council, lovingly known as CDAC here.
It's also long to say, so we call ourselves the CDAC. So thank you to everyone that has gone before me. As a banker, we have the ability to work with all of the industries: medical, transportation, ag, who did I miss? Real estate. How could I forget real estate? And looking forward to community development, because we work hand in glove with community development. So I am going to provide a couple of comments on labor market, but nothing more than what everyone else has said. Also inflation, and of course, being the banker in the room, I'm going to talk the majority of the time about monetary policy. So I will just start off by saying the Great Resignation is over, if that's what you wanted to call it, and retention has improved. So the labor market conditions have come back into balance, in our opinion. when compared to the last several years, with less bargaining power on behalf of the employees. Demand for skilled labor still persists, which we've talked about, especially in the trades and the medical sectors. To meet this need, several technical colleges and several community colleges throughout the 8th District are working directly with local businesses to, quote, train the need in the local communities for the local industries. At banks, the level of open positions looks more like it did historically. Overall, there's been a notable shift in market dynamics, with employers regaining a stronger position compared to prior years. And just an anecdote, I will share that a year ago at this time, we had an open position. We had 6 employees or 6 applicants that were no-shows. And it happened over and over and over again, and that doesn't happen anymore. So take that for what it's worth. You had a question on shedding of labor. I wouldn't say that our council talked about really the shedding and reduction in force at many of our business customers, but being more careful and more of a proactive approach and strategic about who they do hire and how they're going to replace them when they do retire or resign. All right, I will shift to inflation. And Governor Waller, thank you very much for your comments during your opening remarks on soft data. We feel that soft data is very critical and is now changing rapidly. Used to be, we could maybe provide soft data every quarter, every month. Now it's changing by the week, by the day, sometimes by the hour, and it's sending strong signals. So I would encourage you to continue those conversations with all stakeholders. Price increases are moderating compared to previous couple of years, although price levels themselves remain elevated. This is stifling demand across a range of products and borrowers, from home purchases, which we just talked about, to farm equipment and farmland purchases, which we also talked about earlier. Ultimately, the cost of credit in the form of higher price levels is more of an issue than availability, which was one of our questions. Going forward, raw materials, utilities, food, and insurance pricing are expected to be the most impacted over the next 12 months. I do want to comment on insurance. I will say, as a banker, and I think this holds true throughout our entire council, any loan for commercial real estate or a home purchase loan, anything tied to real estate that we had to require insurance was sort of the last thing on our checklist. As we were talking to borrowers, that has elevated to the top of the list because A, we want to make sure they can get insurance in the location that they reside, and B, we want to make sure they can afford them and the credit can still cash flow. So insurance is an ever increasing and ever important issue throughout our economy. Council members shared that the small business customers have absorbed as much as they can via reduced margins throughout this inflationary economic cycle. So now they're at a point they need to start passing those costs on to their customers. One council member indicated that their customers are at a, quote, pivotal point right now, and the speed of change is happening quickly. Several council members indicated that inflation has created an environment of the haves and have-nots, with low to moderate income communities being particularly impacted. Local charities are experiencing an influx of requests, and the banks themselves are receiving more requests for donations. Those on fixed incomes are also seeing an impact, with more retirees coming into the workforce to offset some of those inflationary pressures that they may be experiencing. Communication and transmission of monetary policy. Although there is a lag between monetary policy decisions and the transmission of policy decisions into loans and deposit rates, the reaction from our bank customers is often immediate, and as they react to the news of the policy change, as you can imagine. So when rates increase, depositors call us immediately, wanting to know when their deposit rates will reprice upward, if that is the slope of the curve. When rates decrease, borrowers call wanting to know when they can refinance their credit into a lower interest rate loan. Bankers often find themselves on the front line of explaining monetary policy to their customers, particularly in rural communities, in language that they can understand. So to your point and question on communication, it is difficult for a common consumer and common business customer that isn't in the financial services industry to understand what's happening at the FOMC meetings. And in many cases, they don't know what FOMC stands for. We live it and breathe it every day. We understand all of the comments made, but it's our job as the liaison between bank regulatory agencies and the end customer to communicate that. And we also find ourselves explaining everything from social policy, regulatory policy, and everything else in between. So the Fed's current communication tools with the FOMC statement and the post-FOMC press conference, and of course the resulting media coverage, does generate awareness of the rate decision, but really, as others have communicated as well, doesn't do a whole lot to help educate mainstream and Main Street America. So in our view, this is an opportunity for all of us in the room, not only the Fed, but all of the banks and everyone on these councils, to think how we communicate and certainly encourage the Fed to explore additional ways to make monetary policy more accessible to the general public. And we had all sorts of ideas, so we could talk about that offline if you're interested. In the current cycle of rate increases, the speed at which rates increased had a direct impact on all banks, but the impact was most strongly felt by those that had longer maturity loans or bought longer duration securities. So in hindsight, we could opine on whether or not the Fed should have raised interest rates earlier in the cycle and done so in a more patient way. But we also acknowledge that we were all operating in a highly uncertain environment in the wake of a global pandemic. There are always consequences to our rate increases. Think of the S&L crisis in the early 80s, which fundamentally changed the entire industry, but bankers learned to adjust and manage. We estimate that about 30 to 50% of loans on bank balance sheets have yet to reprice at the higher rates. So this is another opportunity for our communication to come into play. And it continues to put pressure on net interest margin at all banks. We had an extended period of low interest rates post-financial crisis. And as such, there is a generation of our employees. There's a generation of really every American that has not experienced any volatility in rates. And again, it's our opportunity to provide additional communication for those customers. Customer expectations on the cost of credit appear to have finally reset, indicating that our education that we provided to those customers has taken effect. In terms of the dual mandate, price stability, in our opinion, is the most significant component. If price stability is off, it will impact employment. Embedded in the dual mandate, however, we can't lose sight of the importance of financial stability, particularly stability in financial institutions. We are a highly regulated industry, so we are critical. We are the economic engine of the U.S. economy. So it's important that those funds stay deployed within regulated institutions. Overall, the flow of credit is what matters. Normal credit flows support one's overall sense of financial stability. Wide market swings ultimately impact everyone's sense of safety and security. So, in terms of our outlook, typically I and the other council members would render an opinion. However, as has been said earlier, there's been a lot of volatility and uncertainty. Therefore, we are not at a point we can render an opinion. So, with that, I'll open it up to any questions.
So, Luann, thank you, and thank you to the council. I have two quick ones. in 20, one is about one is about transmission, the other one's about communications. And as you said, bankers often find themselves communicating to their customers about monetary policy in one way, shape, or form. In 23 and 24, liquidity in the banking system became a little tighter, so funding became tighter as a result of several things, including rate increases, our rate increases, and post-SVB. Can you talk a little bit about the transmission of monetary policy for different liquidity situations in the banking system? You know, you said your customers call you if they're depositors immediately when rates go up, and borrowers when rates go down. How do you perceive the transmission of policy given the funding pressures that were there, have now abated?
It's a great question. So this particular rate cycle is much different than what we have had in the past, just because the speed at which it happened was unlike any that we've seen in most of our careers, right? So when that happens, there's a lot of confusion, and layering on top of that, because when rates increase rapidly, or by rates I mean the short-term rates that we're talking about, or reduce rapidly, bankers have to adjust their balance sheets accordingly. And we saw a large regional bank failure during that period of time, which created a media frenzy and all sorts of questions from our clients about the safety and security of their deposits. And of course, FDIC insurance became all of a sudden one of our number one questions from depositors. And at that time, we saw a liquidity reduction and an outflow of the financial system. And when that happens, the availability of credit nationally is restricted, and we saw it at that time. Since that time, liquidity has leveled out, in fact, has improved in recent months nationally, and that scenario was just a prime example of the impact monetary policy decisions have immediately on financial institutions of all shapes and sizes throughout the country. So,
thank you. And here's a follow-up. Last year, when we reduced interest rates 100 basis points, I recall a CDAC member telling me, I think you were right next to me when this person said it, said, you know, okay, that was great, improved my NIM, my net interest margin, but I didn't quite understand why you did it. So even though it was a good thing for him and his bank, or his customers, he was saying, your communication wasn't great. Did you hear that also? And what could we have done? What can we do going forward to communicate the, what framework we're following, what rules we're following?
I will say as rates tick up or down slowly, the amount of questions we get from end customers goes down. It's the speed at which it happened is the reason why we had so many. I wouldn't say that when the rates went down 100 basis points, margins improved at banks unilaterally. I think that was hit or miss depending on how each balance sheet was structured. In terms of the communication, I think it can't just be the Fed. It has to be all stakeholders. It has to be, and we had Nikki back there, she's in a rural community, and those that are in a rural community don't have the Fed on their back doorstep. So to the extent we can utilize any sort of, and I know there's a 5-minute economic update that the St. Louis Fed does for banks, to the extent we could utilize something like that, which was Nikki's recommendation to the general public, one specific to ag, one specific to commercial businesses, one specific to the airline industry, what have you. It can help them understand the why behind those decisions. So just one little helpful suggestion that came out of our meetings.
Yeah, I was going to just make a point that what came up is that setting the interest rate is not the only thing we have to do. We have other policy instruments when there's financial stress in the system. We often set up facilities, what we call 13.3 facilities, to try to stabilize financial markets in certain times of stress. And when Silicon Valley Bank failed, we saw a clear bank run. Part of our job as lender of last resort is to step in and do things to stop that as best we can. That has nothing to do with moving the interest rate up or down. But that is one of our core functions in terms of, and I think that often gets lost when you talk about what is our purpose, what does the Federal Reserve do. It's financial stability as one of the other parts of our mandate that everybody, talk about inflation and unemployment, but there is also a financial stability mandate in there. And one other kind of little story real quick. This thing about when people know what the Federal Reserve is, and you said the FOMC. My first date with my wife, I was research director here in St. Louis, and I said, well, you know, I go to the FOMC meetings in DC, and she was like, yeah, whatever, dude, I don't know what that is.
Just a four-letter word.
Just a, I don't know. She had absolutely no clue at what it. Now she's a total Fed geek. You know, she follows everything, watches the chairs, press conferences, and everything. But she was like, whatever. I don't know what you guys do.
Yep. Any other questions?
Thank
All
you,
right.
Luann.
Thank you very much.
Thanks, Luann. And for our final report, we're going to hear from the CDAC, not CDX, CDAC, Community Development Advisory Council, Pastor Andre Alexander from Tabernacle Community Development Corporation in St. Louis will present that. After he's finished, Alberto will close us out.
Good afternoon, everyone. And I recognize I am last, which means I stand between you, flights, travel, and potentially later lunch meetings, etc. So I will try and present what our group discussed, as well as tie up some, connect some dots of some things that have been previously said, and then politely slide out of your way so you can enjoy the rest of your afternoon. So, as he mentioned, I represent CDAC, and our conversation was a little bit nuanced in all three of these topics, whether it was labor market conditions, inflation, or communication. Starting with labor market conditions, for us, because for some of the work that some of us do, we get to see things at different levels. We kind of get to see it at the corporate level, and we also get to see it at the boots on the ground level. And so it was interesting to sit and hear about in the labor market how many discussed there were entry-level positions. For us, we're kind of seeing the exact opposite for the people that we serve on a day-to-day basis. We are seeing more of the middle-level positions being available, but not so much them being able to get into entry-level roles. Or if they are entry-level roles, I know one of the things I personally see at a community level is they are temporary, they don't last long, or they have extreme high turnover for a variety of reasons, therefore leading to instability. So we kind of tackled, highlighted three kind of areas among us as a council: agriculture, healthcare, and construction. And the consensus is kind of a couple of things. First, like everybody in the construction market, we're seeing the need for more skilled labor, as well as to retain the labor that we have, because we're seeing people retire that have those skills, and when those skills leave, they're not necessarily being passed off to those who are coming behind them. Ag, healthcare, we're seeing new kind of partnerships, especially in healthcare, for training to offer then healthcare employees, but again, wondering if it's really enough. And then ag, feeling the impact from immigration policy, having actual people that can do the jobs, and how that's trickling down then into what we see in terms of the next bucket, which is inflation, cost of goods, services, and things like that. And in the inflation bucket for us, it really got interesting because we really began to expand and look at our overall, what I would call, ecosystem. So you're talking healthcare, you're talking childcare, you're talking education, you're talking construction, ag, food insecurity, all of those issues. And a common thread is the idea of how uncertainty in itself seems to be then impacting inflation also. Meaning, for example, One of our colleagues spoke about a child care center that once they began to look at numbers in terms of cost of building facility, expanding, adding employees, potential rise of inflation costs, they immediately stopped the project. Well, stopping that project stops healthcare, childcare. Childcare then stops jobs for families. Then you have this domino effect that impacts across the board. We have seen as an organization, because of cost of goods going up in grocery stores, one of the things we have is a food pantry. In the last 30 to 60 days, our request for our food pantry has tripled because of people who normally would not need it, now need it, or the fear of, as things continue to rise, I want to be ahead, and so they are accessing it. On the construction side, we are all seeing the cost of to build is going up, whether it's affordable housing, luxury housing, commercial projects, etc. We are in the middle of a housing project right now, and I share with our group that when we started building these houses over a year ago, we were at one price point of about $290 to build. If we start that same house today, it's going to cost us about $360. That's the growth of it. Another part of it in inflation is the idea of when we start talking about advancements in technology. Well, when you invest technology and equipment like HVAC systems and other things, guess what? They pass on that cost to those who are building and buying the parts to build it. And so cost of the house goes up, and there you have it. And so it's a domino kind of effect across things. And this, I would say for me personally, really got me. Even though I saw it, I didn't see it. One of our colleagues mentioned that DoorDash now has, you can pay ahead, for your food. It's like buy now, pay later for DoorDash because cost of things going up. Now, some, it makes us cringe and go, ooh, why would you do that? Just don't buy the cheeseburger, right? However, if it gets down to I need to feed my family and I don't have another way to do that, a lot of times we'll kick the ball down the road, so to speak, just so we can take care of the immediate need, not necessarily thinking through the long-term consequences or implications of that decision. So we're seeing inflation at the community level impact a variety of areas. And again, all of them are dominoes. They all connect together. So when one domino falls, we see all of them fall, which can lead to, a conundrum, if you will, of additional challenges. And then lastly, you get into talking about communication, which we echo all the statements that have been made. I think if we could add anything there in that particular category is speaking more to how things practically play out. So for example, as mentioned, I come home from my CDAC meetings, I start talking to my wife about what I learned, and she's like, okay, so that's how you spent your day. All right, that's great. But when I start mixing in, well, this gets into, that new kitchen you've been asking me for, and if we can do those quiet closing cabinets that you like, now all of a sudden it's a different, and she's more attentive because we've put it in something that she can practically, tangibly touch. And so I think if there are ways for the Fed to do that as it communicates monetary policy to everyday people through the different mediums that are available, now all of a sudden I think you get more understanding. Another thing we brought up is how you paint those pictures practically. For example, here you have a wonderful museum, but it only has certain hours. And so, for example, some of us in some of our communities couldn't necessarily bring young people in particularly to that museum because it's during school hours. But what would it look like if one day a month you had hours open after school hours or on a Saturday? Now you can invite a different audience in that then can see things practically, because everybody learns differently, and put it in a setting where they feel comfortable. So in terms of outlook, I think overall for us, one of my colleagues said it best, uncertainty breeds us to not make certain decisions. And I think that's kind of where we're at in community spaces as we look at how we are impacted through labor and inflation challenges. So.
I just have one question. It ties back to your comment about the museum, which is a large part, and I started my day talking about the importance of our outreach to the community. That's partly why we have this decentralized structure that we have, unlike any other kind of agency in the U.S. government. What would be your piece of advice for us to do better at community outreach?
So as a pastor who loves talking to people, I think if you can do, and I understand scheduling things are tight, if you can do sessions in communities where people are, I don't know, twice a year, once a year, because as I share with our group, when I say I'm coming here, a lot of my friends, where is that? Where is that building? What are you talking about? And I say, oh, you drove past it the other day when you went to the baseball game. Oh, yeah, that place. Oh, okay. So if there's a way to actually disperse into areas where people live, work, and play, I think that would be helpful.
Pastor Andrea, thanks for the remarks. I was very struck when you, I don't know if you were doing it, but you did it. You talked about the inflation versus employment dual mandate when you gave the example of higher costs caused the cancellation of a project, which caused impacts on people's ability to have daycare and therefore employment. And so you drew the line from one to the other very clearly. The question I wanted to ask you is, in the communities you work with and that you serve, you talked about inflation a lot as being very regressive, meaning it affects folks on fixed income and low moderate income folks more than other folks. I didn't hear you talk about employment or unemployment too much. And of course, we know that a long unemployment spell for someone can really change the course of that person or that family's life for a long time. So when you talk to the folks or when you get input from the folks that you work with, what would be the balance for them in terms of our dual mandate, inflation, price stability versus maximum employment?
President Musalem, that's a great question. I think for the people that we serve and work with on a daily basis, they would probably say, no question, employment. Because I think in their minds, and one of my colleagues said this, if you can keep me employed, I can kind of on my own figure out the inflation piece, meaning I can figure out where to cut back, what to do, what not to do, and somewhat manage that to the best of my ability. But if I'm not employed or employment is sketchy and the cost of things start continuing to go up, like one of my colleagues, Carol, mentioned in Northwest Arkansas, it had data that showed, okay, the average income coming in is about $1,032 a week, but then the cost of living is, let's say, $1,140 a week. Now, all of a sudden, if that keeps creeping up, then there's no way for me to catch up. And if I get unemployed, then I'm really far behind. So I think they would say, keep me employed, try and push to keep my wages livable, and I'll figure out the inflation piece.
Thank you. Thank you very much. Okay, I think we had a fantastic, Fed Listens event. Governor Waller, thank you for coming to St. Louis again. Thank you for everything you do for the system. We are all very grateful for all of you for having come here, taking precious time out of your work days and work week, flown, driven, however you got here. And we will take all of these insights back to think about the next FOMC meeting, but also to think about the arc of what we're here to do, which is think about our monetary policy framework for the next 5 years. You've all heard me say when I have visited with you in the past that I take these conversations very seriously. Often I repeat them at the FOMC. I don't attribute it to any one person, but I do relay them, and I know my fellow other presidents and governors do the same in terms of the outreach that we do. As I said yesterday, I hope we certainly benefited a lot from this, but I hope all of you benefited equally from hearing each other and you'll take all the learnings back to your places of business and communities. Thank you again. Safe travels back home. We really appreciate this.